Hello, and welcome to Chapter 11, Sales Controls and Analysis. The objectives upon completion of this chapter: you should be able to implement proper guest check controls to meet business needs, follow the flow of sales from guest check to the income statement, calculate sales mix from sales history reports, calculate the break-even point of sales, and complete a menu engineering worksheet. Menu engineering worksheet we're going to be saving for our very last. When we talk about sales control, we're getting down to the analysis. We're getting down to the nitty-gritty of what we've been doing in class up to date. We've been understanding what a P&L statement is. We've been learning all the intricacies of how to create a cost card. And so now we're going to analyze what we've created, what we've done, and see if it makes sense to us. Okay, so sales is actually the total dollar amount brought into the restaurant through the sale of food and beverages to its customers. We learned this is also called the revenue. Sales control is a system set up to maintain and track the flow of sales, money and items sold to its customers. So it goes from the guest check to the cash register, then on to the sales journal, and then to the income statement. Let's talk about the income statement a little bit. When we want to analyze the income statement, we need to look at what's called the variance. So to complete this variance, you take your current period, you deduct your last period on the same line, and this gives you your variance dollars. To find the variance percentages, you take the variance dollars and divide it by the last period dollars, and that gives you your variance. The food covers plus the bar covers equals the total covers. To get the labor cost per food cover, you just take the total payroll and related amounts and divide it by the total covers. To get the silverware expense per food cover, we get the silverware and we divide it by the food covers. To get the marketing dollars per cover, we take the marketing and divide it by our total covers. Now these are important because if we're not bringing in enough people, then maybe we need to adjust some of these areas. So how do we find out how many people we're bringing in and how much they're spending? Well, we take for the average food check, we take the total sales and we divide it by the food covers. For the average bar check, we take the total sales and divide it by the bar covers. And then to get the average total check, we take the total sales and divide it by the total covers. So basically, you enter in all your financial data. Now remember, where food and beverage sales are broken down separately, you want to compute the percentage of food costs by dividing food costs by food sales. And the beverage cost percentage is done by dividing the cost of beverages by the beverage sales. Then you'll compute the variances by dividing the difference between the figures as shown in the previous slide. If the variance is greater than plus or minus 10%, further analysis should be made to determine the reason for that variance. So these are some factors that may require budget revisions. The opening and closing of a major director competition. A significant long-term or permanent increase or decrease in the price of major menu ingredients. Significant or unanticipated increases in fixed expenses such as utilities, insurance, or taxes. A management change that significantly alters the skill level of the management team. Unplanned road construction that significantly affects customers' ability to reach the establishment. Natural disasters such as floods, hurricanes, severe weather that significantly affects forecasted revenues. Significant changes in the establishment's operating hours. Permanent changes in service style that appreciably affect labor costs. Changes in financial statement formats or basis for allocation or financial resources. Significant changes in variable costs that offset revenues. The loss of especially skilled employees. These are all different reasons of why we might have to revisit our budget and make accommodations for. So in order to make those decisions, first thing we need to do is define the problem. An example of defining the problem would be the check average for food has been declining for the last 3 months. Step 2 would be determine the cause. So we want to note the following: suggestive selling, menu problems including pricing, errors in procedures for calculating customer check average. How about server theft? Step 3 is determine and evaluate alternative solutions. Customer shoppers did not respond to suggestive selling. They need training. Menu recently redesigned. Customer counts are up slightly. An auditor has found no bookkeeping problems, suggesting error or employee theft. Step 4. Select the best alternative. Implement a suggestive selling program. Step 5. Develop and implement an action plan. An example of that would be to train the service staff and implement a contest. All servers with specified minimum customer check average win a prize. And lastly, Step 6. Evaluate and document the solution. An example of that would be to determine how much the customer check average increases after the suggestive selling is rolled out. So, here we're looking at a problem. Is it preferable to increase revenue or decrease variable costs? So let's look at some examples here. By increasing the revenue by $2,000, this yields only a $600 increase in profit. $1,600 minus $1,000 is $600. But by decreasing the variable costs, meaning we can decrease variable costs by $2,000, increasing the profit by $2,000. So $3,000 minus $1,000 is $2,000, right? So by looking at this, we can say comfortably that it's better to reduce labor and food costs than to bring in a few more customers. Now let's continue on with what is the problem. So which of the following costs should be managed first? Which is priority? Okay, so we looked at our food costs, our actual and our budgeted food costs, and we saw that there was a 2% difference. And then we looked at our beverage cost. Our actual was 30% and our budget was 25%, and there was a 5% difference. At first, it appears that the beverage cost represents the bigger problem, a 5% variance compared to only a 2% for food cost. However, a few more details may affect that opinion. So when we're looking at the food revenue, we have the actual cost at dollars are $350,000, and our food cost percentage for the actual is 34%. Now we're looking at the budget, it's 32%. So that gives us our total average cost of $119,000 as opposed to the budget, which was $112,000. So the difference is a lot bigger at $7,000. Then when we look at the beverages, the beverage revenue was $100,000. The actual percentage was 30%. The budgeted percentage was 25%, giving us that 5% variance. So when we did our numbers, our actual dollars for our beverage cost was $30,000. Our actual dollars for our budgeted was $25,000. So that gave us a difference of $5,000. So in actuality, we needed to look at the food cost as opposed to the beverage cost, even though the difference was 3%, between 2 to 5%. So you can see how it can be a little bit tricky if you just take the percentages on their own. Okay, sometimes we're going to take that analysis and decision making and then we're going to evaluate the quality. We like to do that through kind of like a secret shopper. So basically what you want to do is give your manager and the chef the same type of information that you would give to a secret shopper. So the product checklist would be, was the items delivered properly? Was the aroma attractive? Was the appearance and plating attractive? Dish was clean? Did the dish look like the menu description? Was the garnish correct? Temperature correct? Seasoning correct? Flavoring, texture, doneness? So basically, as the manager and the chef do this, and then you have a secret shopper come in and do this, you're going to see a lot of changes need to be made. And basically, you want to make sure that these changes are done, as well as point it out during a pre-shift meeting. So when we're looking at quality as an improvement philosophy, we want to look at examples of product deviations and why. So we looked at once before why circumstances were posted in the journal of why we had errors on returned items. Well, this would be more of a secret shopper error list, and you would put down, or an expediter might be doing these checklists. So you want to make sure you put the manager on duty, date, shift, day of week, and also put down any circumstances, like the weather's was raining outside, or there was a special event, so you're a little bit too busy. You want to create who actually created the problem, put down what item was noted. So like on the first example, note garnish on the grilled salmon. Put down the time, 6:15. Look at deviation. So parsley not in the dish. Look at a resolution. The prep cook needs to get parsley from the storage and put in the garnish tray. And the suggestions would be to have more parsley on hand before shift starts. Okay, so you get the general idea. It's just making sure that you hit all the problems in any kind of deviations from your quality standards. Now, when we're looking at the guest check control, most operations use computer-generated guest checks now, where the computer itself is a control. So we really don't have to worry too much about hand-prepared guest checks. But if you do still use the hand-prepared guest checks, a control form must be utilized. So we have an example of that in Appendix D. So what we typically do is issue the guest checks insurance inventory, and then the guest check audit. So basically every single guest check has to be accounted for in this purpose. When looking at the control points in the cash register procedures, we need to make sure we're recording all sales transactions, including any transactions the till was open for, a placeholder for all payments, and then we're going to be looking at the cash register reading. We need to prove all the payments collected. This is the recorded sales. We need to compare them to our recorded sales and the payments collected. The results are posted to a daily sales journal, and that's where we got our information for the sales, for our food cost percentage, day-to-day accurate approach, and simple approach. So when we're looking at the daily sales journal, it illustrates all the types of sales recorded in the payments collected daily. At the end of the month, each column is totaled to determine the monthly results. So you can see here, it says our food sales on day 1 was $11,535.25. Our beverage sales was $3,453.76. We didn't have any other sales, so our total sales added up were $14,989.01. We include our sales tax, which was $749.45, and any tips charged, so that was $988.50. So our total combined collection was $16,726.96. Now we're going to count up all the cash. So we found that the cash in the till was $8,706.95. All checks accounted for were $400. MasterCard and Visa cards, $5,783.22. American Express, $1,636.79. Gift certificates, $200. So now we're looking at all the different payments, and the total payments came to $16,726.96. Now, if there was an error in this, we need to look back to see where the error occurred and make sure that it was not a theft error. So the annual sales journal is made up of the monthly sales totals for each of the sales categories from the daily sales journal. So the total of the annual sales journal is used in preparing the annual income statement. When we refer to covers, we're talking about the number of customers served. The average sale per customer is the average dollar amount spent by each customer. So our total sales divided by the number of covers served gives us our average sale customer. So when we say we made $9,200 in one day, we divided that by the 250 customers we served, that gave us the check average of $36.80. We can also do this per server as well, so that gives us the idea of how productive each server is. When using the average sale per cover, knowing the average sales and the cover can help to forecast future sales. So we take the average sales per cover and we multiply it by our forecasted covers, and that gives us our forecasted sales. In this example, $36.80 was our check average. We multiplied that by 400 customers, and that gave us $14,720 sales. And these are going to be forecasted sales for the future. Often managers want to know how much each server's average sale per cover is individually. So the waiter total sales was $600, and we divided it by the covers served, and that waiter served 35 people. So the waiter's average sale was $17.14. So this comes in handy when we need to account for taxes and tips for that particular server. And we also want to make sure that that server is upselling, so we can help them to do their job a little better. So let's look at contribution to sales percent. The contribution to sales percent equals the percent each menu item contributes to the total sales. So it's pretty much what we did with the sales mix. The number of dollars of each menu item sold divided by our total sales gives us the contribution to sales. So we sold 364 items. We divided that by our total sales of 4,000, and that gave us a 9.1% contribution of those items sold. Now going into the break-even point of sales, this is the point at which the sales dollar is brought in and is equal to the cost expended to produce those sales. When we talk about menu engineering, we analyze the popularity and contribution of the margin for each menu item. So when we're calculating the break-even point of sales, this is often calculated based on a 1-week time period, and we will do this in class. The information needed is the weekly labor cost dollars. We also need weekly overhead cost dollars and the cost of sales. The formula is labor cost dollars plus our overhead cost dollars divided by 1 minus the cost of sales percentage. This gives us our break-even sales. Continuing on, remember the cost of sales, food and beverage, is a variable cost. Labor costs and overhead costs within the break-even formula are fixed costs in this example. So a simple way to solve for the break-even point of sales is to utilize a tool that's similar to the simplified profit and loss statement. So when we see here, we have our break-even sales. The University Inn has an estimated weekly labor cost of $12,700 and an estimated weekly overhead cost of $6,800. The restaurant normally maintains a 35% cost of sales. What's the break-even point? We plug the information into the break-even chart, and this gives us labor cost plus overhead cost equals our fixed cost. So we have our fixed cost at $19,500. Our variable cost is 35%. If we know our break-even sales is 100%, then what would our fixed cost be? Well, our fixed cost is 65%. So since sales is always 100% and the variable cost percentage here is 35%, our fixed cost can be determined as 65. That's 100% minus 35%. If the fixed cost is $19,500 and is 65% of the break-even point of sales, we can calculate the break-even point of the sales by dividing the fixed cost by the fixed cost percentage. So here's where we can really pull in that power triangle, or the triangle that we were using in class. The fixed cost of $19,500 is divided by 0.65, and that gives us our break-even point of sales at $30,000. So the manager now knows the operation needs to bring $30,000 in sales to break even. What's the cost of sales? Our variable cost budget. Our break-even point times our variable cost equals break-even sales. So 30,000 times our variable cost at 35% gives us $10,500. Using the information from the previous example, the University Inn needs to bring in 30,000 sales weekly to break even. Let's compare the break-even sales, 30,000, to our actual sales at 35,000. The restaurant did bring in to determine the amount of profit earned. So we have 35,000, we minus our break-even sales of 30,000, that gives us an additional sales of $5,000. So basically what it's saying here is the business brought in $5,000 more dollars than it needed to break even. That's always a good thing, right? We like raising our profit. So as we know, 5,000 does not represent a clear profit, since a sales increase requires a variable cost increase. If sales rise by 5,000, how much was spent to purchase the goods that were sold? So let's do the formula for this. The additional sales times the cost of sales percentage equals additional variable cost. So we take the 5,000 times 0.35, and that gives us our variable cost of 1,750. If the University Inn spent 1,750 of the additional 5,000 to purchase the goods sold, the university realized a profit of $3,250. This is labor costs and overhead costs are fixed costs for the purpose of break-even. Covers. A second way that businesses use theory of break-even is to determine the number of covers the business needs to break even. So we have our fixed divided by the average sale times fixed gives us our break-even. So we have 19,500 divided by our check average of 36.80 times 0.65, and this gives us 815 covers in order to break even. Okay, we'll stop here and we'll discuss menu engineering on our final and last video series. See you in class.